to forward.
We think our children have to have the best. It's all about discipline.
How are we going to discipline ourselves so that we're able to save, so that we're able to make good financial decisions?
Recognizing that there's a road ahead if you manage the road in front of you.
The decisions that you're going to be making today in your lives where it comes to money will affect you in the future.
Discipline is one of the things that we often learn, sometimes by our environment, or sometimes we're forced to do it, and sometimes we don't learn it at all.
Stores want to get us in and out and get our money, and that's it. It's a game, so you have to be really wise to the game.
Do you know what it costs to run your home on a monthly basis?
Land acknowledgement. As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Séniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement pour les ressources autour des Grands Lacs. Aujourd'hui, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
This webinar Good morning, everyone. Thank you for joining us.
Good morning.
Fantastic, there we go. Thank you, Victoria, who's working, as always, behind the scenes to keep us moving. So welcome to Community Space, the space where community gathers to talk about issues of importance and interest to the Black community. We are joined this week again by Professor Marcia Annisette, Associate Dean and Professor of Accounting at the Schulich School of Business at York University. And we had a really engaging and fantastic discussion on accounting last week. So we are ready to go for our second go at it this week. So Professor, we'll turn it over to you. And just a reminder to folks that these sessions are being recorded. So of course, if you miss a portion, please do check out the BBPA's YouTube page. These are normally posted a week to 2 weeks post-session. Of course, you can turn your videos off for privacy issues, but if you're going to ask a question, we then ask you to please turn your camera on, and you may ask a question by posting it in the chat, which we are indeed checking, or by raising your virtual hand, and we'll call on you throughout or also at the end for the dedicated Q&A. And final reminder to just stay on mute unless you're speaking. So over to you, Professor.
Okay, before I say the welcome, let me make sure that, I have my technical stuff going right. Tika, are you seeing the slideshow or just the slides?
I'm seeing both the slides and your own slideshow.
Okay, right. So you have to help me navigate.
So you want to go to from beginning? If you click from beginning.
Okay. I should know this better. So are you seeing the
That's
slideshow?
okay. There we go. So just your slides.
Okay, good.
Fantastic.
As I normally work with multiple screens and I only have one screen this morning, so I'm in a bit of a tizzy.
It's okay. I know it's.
Yeah. So, welcome everybody.
You can put us on.
Sorry, just a reminder to please mute yourselves. Thank you.
Okay, so it's good to see so many of you have returned from last week and you have not run away because of accounting, which tends to be very tedious and boring. And, as I was telling Tika before, after how many years of teaching accounting, many times you enter the first class and people are like this, because they're bracing themselves to this boring, difficult subject. So it's really good to see that, enough people felt that it was worth coming back again to spend, a beautiful Saturday morning with me to talk about accounting. Just to remind you of what it is I'm trying to do here. It's really to help improve your financial literacy through the lens of accounting. One can do that through other lens, but I am doing this through the lens of accounting. It's important though to remember that accounting it did not start as a theoretical discipline. It's not like economics, which started from abstract theories. Accounting developed as a practical tool used by traders, by business people to help them manage their commercial affairs, not even their personal affairs, but their commercial affairs. It was then elaborated, this tool, this practice was elaborated for the use of business enterprises and mainly public corporations. Hence, any accounting textbook you open, one of the first lines you will see is accounting is the language of business. So my approach really is to use the principles of accounting and to convey them to your personal life, even though you are not a business. And I am doing this for two reasons. One, I often find that abstract ideas, which is the reason some people find accounting can be very difficult to grasp because it's built on some abstract ideas. And I find those are easier to grasp when they're personalized. So, I'm taking something that was designed for companies and trying to personalize them. So some of my examples may seem unrealistic and extreme, but it's really designed to help you grasp the idea when I take something from a corporate or company setting and try to personalize it to our individual lives. But there's another reason too, because even though accounting was designed for businesses, I have often found in my own personal life, using some of these principles and applying them to my own personal life. Again, I'm not a business, but it has helped me manage my own financial affairs and look at things as though, I were a business. So, just to come back to what are my two objectives here. One is really to help you understand financial statements, that everybody here can look at a set of financial statements. Air Canada, Amazon.com, any company, you can look at their financial statements and make reasonable, intelligent assertions about those financial statements. But also too, to help you use the principles that you use to understand those financial statements, to apply them to your own personal lives, that you can actually have working in your head, your own personal financial statements that could help you, as I said, manage your personal affairs. So with that, let me move on to, recapping. Let me just get rid of some of the things that I'm seeing on my screen here. To recapping what we did last week. One of the first terms that we grappled with last week and tried to break down is this term wealth. We all use that word in our normal parlance. And what I tried to do is break down that term from a very accounting point of view. And what is wealth? We all have a feeling of what wealth is, but there is an exact mathematical expression of what wealth is. It's total assets minus total liabilities. And we tend to use the word net worth or the phrase net worth in characterizing an individual's wealth. So you can Google, what is Oprah's net worth? What is Barack Obama's net worth? What is Jeff Bezos' net worth? That is really, when you see that figure, it means that somebody has taken their total assets, summed their total assets, taken their total liabilities, minus the liabilities from the asset, and that's what they're talking about. We looked at last week, what do we mean by assets? And really, assets is anything that brings value to the corporation, to the individual, okay? It is owned, it must be owned, and it must bring value. We realize that some assets become more valuable as time passes. For example, anybody can, and Tika, again, your job is to manage the chat, right? Anybody can give me an example, or you know what, don't even chat. Open up for everybody to talk if anybody wants to shout. Any asset we know whose value increases likely as time passes?
Perhaps I'll go first. Real estate.
Real estate, generally. You buy it today and you don't have to do anything but fold your arms. And, its value goes up. So there are some assets who just time increases their value. Some assets, most assets, on the other hand, are of diminishing value as time passes, right? For example, as I said, a motor car. Everyone tells you that as you sit in that car and drive it out of the dealership, its value decreases. But we don't, sorry.
I was going to say there's some responses in the chat. So
let's go through them, yeah.
Art.
Yes.
Sador says the 2011 Porsche. I'm assuming there's something very specific about that one, but maybe classic cars in general.
Classic cars in general.
Sarah mentions bonds.
Yes, and anything like collector's item. Somebody said bond?
Yes.
Not necessarily, but I will get to bonds later. Bonds may, but they may not. The value of bonds really fluctuates according to how interest rates move. But that's a long story and I don't want to get there. The idea, however, is you expect bonds and stocks, you expect their value to increase. But let's not talk about financial assets yet. What else did you see there, Tika?
Sorry, I muted myself. That's it.
That's it.
Monica says education with a question mark. So
yeah, I mean, the value of education, it may or it may not, it depends on the type of education, because things may become obsolete. Right, you may have been educated in, let's say, a computer program 10 years ago. Well, at Fortran, right? That was fashionable in my day. I mean, I didn't do it. It may not be valuable now. However, maybe some of the principles may be. But I like that. I like how people are really thinking out of the box here.
yes, Camille mentions inventory.
Inventory, again, it depends. She's mentioned a term that maybe not everybody knows, so let me just spend some time explaining what inventory is. It is what a business, and we're now looking at a business, what a business purchases for resale. So let's say I am in the business, I am very entrepreneurial, and about a year and a half ago, I decided everybody's going to need face masks because we've got COVID, and I designed these nice face masks out of kente cloth and said, I mean, nobody likes to walk around with that blue ugly thing. Let's get, something really fashionable and so on. And so that's my business, selling face masks. And I make a lot, and I hold them to sell. That becomes inventory, right? Let's say it cost me $5 to make, or even let's say I bought them from someone in Nigeria where they can get the kente cloth. So it's $5. There is a potential that its value will increase because I'm going to sell it for $8. But let's say I have a lot of these face masks right now with the potential that their value will increase. And then we go into phase 3 soon. And Doug Ford said, you don't need to wear face masks. Is it still valuable? Okay, so it depends. Ideally, you're right, Camille. If you're in a business, a viable business, what makes the business viable is that the cost of your inventory, you could sell it. Its value is going to be higher when you sell it, but not necessarily. Things in the market may be such that you can't sell it or you will have to sell it at a discount. I think what is really coming out here and what is really exciting is that people are seeing that assets are different. They have different trajectories. They have a different nature, and which is what the slide is saying. They come in many forms. I just want to move on very quickly. Some are idle. I spoke of cash. Cash by itself does nothing. And in fact, if you have cash, it ultimately decreases in value, and I'll tell you why. The prices of things go up. So if you have $100,000 under your mattress, what you could buy today for that 100,000, 2 years from now, that same 100,000 is going to give you less. So actually cash by itself, in terms of, dollar notes by itself, is an idle asset. Its value actually is diminishing because what it could command in terms of goods, because we live in inflationary times, is going to be less. And the real value of cash to you is that it allows, and to businesses, it allows businesses to acquire more profitable or more value enhancing assets. We can take the cash and buy inventory. We can take the cash and purchase land. We can take the cash and buy bonds and stock, which put us in a better position than if we just had the cash locked there in a vault. Some are speculative, and which is why, you know, someone mentioned bonds and stock. They are speculative because their prices can go up and down. The idea is we hope that their price, when I say their prices, their value, right? We hope that their value goes up. You know, I have a cousin of mine, she lives in regret. 3 years ago, she had stocks in Shopify and she sold them at some ridiculous price because, of course, she didn't anticipate that COVID would happen, and Shopify, the value of Shopify stock just went out of the window. So they're speculative. You don't know, you hope that the value goes up. Importantly, in all of this discussion, I mentioned two things that I want to bring out. Some assets, we go out and buy them for their use value. Okay, and businesses and individuals, like a car. You don't go out and buy a car, except it's that, what was the car that was mentioned, Tika, right?
The 2011 Porsche.
The 2011 Porsche. You don't buy a 2011 Porsche to drive to the supermarket. It's not for the use value, right? You buy the 2011 Porsche, or even the spectacular work of art, or the stocks and bonds, really for their market value, the expectation that their market value is going to increase sometime in the future, and that you can sell them and make a profit. But some others you buy for the use value. You buy your motor car for the use value, what it can facilitate your daily life. It helps you, your motor car actually helps you increase wealth, because you can drive to work and earn income with the motor car, and so on and so forth. I'm using a term, income, which we will get to later. So, you know, someone mentioned education and knowledge as an asset, and that is an asset. And I think it falls into the last category, which is always important to remember when you start looking at the assets of a company. There are some things that cannot be measured. There are some assets that cannot be measured, because one of the limitations of even talking about assets, right, and quantifying assets is that they are subject to quantification, right, and monetary quantification. You cannot quantify the monetary value of education. You can probably quantify how much you spent, but in terms of its value, you cannot quantify it. The second item, concept in this, you know, bigger concept of net worth is liabilities. And I'm just going to go through this very quickly because I want us to move on, but I want us to sort of take some of these to move on. So it's important to recap. Liabilities, like assets, they come in many forms. Some are cheap, and we know why they're cheap, like mortgages are cheap. Right now, you can get a mortgage at 1.something% interest, right? The interest is the cost of borrowing. Nobody's gonna just lend you money costless, unless they're your friend, your parents, and so on. So mortgages are cheap, and they're cheap because the lender has security that if you default, they've got an asset. And the sticker said, typically a mortgage is on property. They've got an asset whose value is appreciating. So they have every guarantee that when they exercise the lien, which is the charge, the claim they have on your asset, that they can sell that asset, pay back themselves what they lent you, and there will still be some left. So that mortgages are cheap because it's really a fairly low risk to the lender of lending you money because they tie up that asset. It's yours, but don't be foolish and not pay them back, because it then becomes theirs. They can exercise a lien. That's called secured borrowing. Some liabilities are expensive. Credit card debt, because the lender is taking on all the risk. That's why it's 20%. They charge really high because they have little protection. Some liabilities are long-term. Mortgages could be 30 years, 20 years. You have a long period over which you repay what you borrowed, which is called the principal. The principal is that portion that you borrow that you pay back periodically. The interest is the cost of borrowing. And some are short-term. A bank overdraft, if you have a bank overdraft and use it, it is short-term, because if you read the fine print, the bank can call on the overdraft anytime and you have to pay them back. And some, as I said, can be cost-free and informal loans, right? You borrow money from a friend or family member or your parents, and you borrow $10,000 from your parents. You say, okay, mom, dad, I'll pay you back 5 years from now, $10,000. All you do is pay back the principal. It's cost-free. There's one that I want to talk about, because I remember when I was telling my old aunt about it, it never read, I don't know if she ever got it. But how many of you get upset when at the end of tax season, you don't have a refund, but you have to pay over? I think most people want a refund, right? How many are happy when they have to pay over? Would you believe it's better to have to owe tax than get a refund? And I'll tell you why. We all have to pay taxes, there's this saying, the only things that you have to do is die and pay taxes. So taxes, you have to pay taxes, right? When you make a refund, when you get a tax refund, it means that your employer has been deducting too much tax from you and giving it to the tax authorities. So a refund is really when you have lent money to tax authorities over the year and they're saying, oh no, you gave us too much money. Let me give you back, right? That's what the refund represents, that you have lent them money, you have given them over too much money. When you have to pay over tax, it means that your employer has deducted too little tax, right? And therefore, at the end of the year, when we make an assessment of your income and all of the tax deductions, the money that you should have paid over, that is legitimately belonging to the tax authorities, you owe them. It means you have effectively borrowed money for free, 0% interest. So in a sense, if you can work out, you know what, out of my income, I have to pay $10,000 tax, right? But over the year, your employer has only deducted $8,000. What you should be doing is sort of saving that $2,000. You could save it, you could earn interest on it, knowing that you are actually borrowing money from the revenue authorities. So really and truly, when you have to pay tax at the end of the year, it signifies that you have borrowed money cost-free. I know a lot of people are not going to buy that. It's like, no, give me the refund, but the refund means that you have overpaid over there. Hopefully people get that. And, you know, if not, I can spend some time in a later session explaining that.
I think it would be good. I don't know if you have that for this session or future sessions, but to talk about Kofi Sankofa mentions tax strategy and management as part of accounting.
Okay, what I will do is, and you know, I was thinking about this last week when people started talking about, you know, some of the things they're interested in. I am not a tax expert, so I could give rudimentary sort of insights, but I have a colleague who is a tax expert, and one of the things I did think that I would do for probably the last session is bring in a panel of experts to speak to some of the issues. And so one of the colleagues is a tax expert, and he teaches, you know, tax planning, tax strategy. And I think,
that would be fantastic. Yes.
Yeah, so I do have a nice lineup for the last session of, you know, individuals from various walks in life whom I really, really respect. So, oh, I now see that I actually can look at the chat. If you commit tax fraud, make sure you do it. We can leave the country. Okay. So let's move on from that summary of week 1 and move on to you know, the new content for today. And you know, today I want to talk about measuring wealth, right? And representing wealth. As we said, wealth starts with having a sense, an ability to quantify total assets. So in this example here, we have, I'm giving an example, somebody's total asset portfolio is $1 million. Their liabilities we have quantified are $200,000. We all know their net worth, therefore, would be $800,000. If we look at these two boxes, you know, in a sense, assets minus liabilities. So if we take that piece out, I hope everybody is following me here. If we take that chunk out of the asset block, what is left below would be net worth. So one can actually visually represent net worth by that gray box, which is total assets minus total liabilities, and that gray box represents the net worth of the company or the individual. What I have represented here is what is called the balance sheet equation, right? The balance sheet equation, and in fact, is a template of what a balance sheet is. A company balance sheet, an individual balance sheet. Any balance sheet will have these 3 elements, and it's an equation, and the right-hand side must always equal the left-hand side, because effectively what this equation is doing is saying, well, 1 million is your assets, 200,000 is somebody else's stake in your assets. You have borrowed $200,000 to finance those assets. And the remainder, which is net worth, is your own stake in the assets. So that might be, as sticker says, you have one asset, a piece of property. You went to the bank, you borrowed $200,000, and you put your own $800,000 in it. So there are different ways we can explain this balance sheet. We can look at the gray area and say, oh, the wealth of this person is $800,000. Their net worth is $800,000. their total assets minus their total liabilities is $800,000. Something that we've been saying since last week. But we could also look at it this way and say the left-hand side, the blue side, talks about what they have. This is what the entity owns. And on the right-hand side, we are talking about, well, who financed it? Is it third parties, liabilities financed what they own? Or is it the individual themselves? And what are the ratios? Let's see, how much of what you have really has been financed by somebody else. You think of Donald Trump, and one of the problems with Donald Trump is that everybody knows about the blue side. They don't know about the right-hand side. And there is a question whether that pink area is much bigger than what is demonstrated here. How big is that pink area? And how much that pink area, how big it is, and how much it is owned, or I should say contributed by the Russians. That is a big issue in the US, right? How much of what he owns, pink, is really underwritten by the Russians and by other parties. Everybody's with me there. This is really fundamental. As I said, it's called the balance sheet equation, and you would always hear people say assets equal liabilities minus net worth, right? Sorry, assets is equal to, in this case, liabilities plus net worth, which is the same as saying assets minus liabilities is net worth. Okay, so it's just taking what we already know and representing it differently. This understanding is going to be fundamental to understanding company accounts later on in the session. So it's important that you get this sort of visual representation of, how we can rethink this concept of net worth and wealth in terms of the balance sheet equation. So for the time being now, we will not look at company accounts, but let's just play a little bit with some balance sheets, right? As I said, this diagram with 3 major boxes is something that you should always carry in your head when you're looking at a balance sheet. What are the assets? What are the liabilities? And what's this thing called net worth? So here we have 3 balance sheets, and I'm going to ask you again, Tika, to help me in the chat, right? And, ask a simple question. Which of these 3 balance sheets you would like to be yours? Which one is better and why?
So feel free to post in the chat or just speak.
Yeah.
So I see some C's in the chat. Balance sheet C, I think is the only.
It's unanimous.
Yes, unanimous.
It's unanimous, right? And so we get the balance sheet equation already, right? That, balance sheet C is better under certain circumstances. If the nature of the assets in A, B, and C are exactly the same, and the nature of the liabilities in A, B, and C are exactly the same, definitely, I want to be balance sheet C. I want to have far more stake in my assets than balance sheet B. And of course, we could prioritize them. We would say A is better than B, and C is better than A. So if we had to sort of rank them, we would say C number 1, A number 2, B number 3. And why? clearly, visually, C has higher net worth because the liabilities are lower, given the same stock of assets. And of course, once liabilities are lower, in theory, risk is lower because it means a third party's claim on your assets is lower. So again, you know, when looking at financial statements, you may be looking at two companies wishing to invest in two companies, and you have your financial statements, looking at the balance sheet. These are the templates you will have now. What are their assets? What are their liabilities? What's the ratio between liabilities and this thing called net worth? Because I now know net worth is really the stake owners have in the business, and that gives a sort of a solid sense of, you know, the safety of the assets that the entity owns. So let me complicate things a little further now. Now that we kind of can already are beginning to have some really intelligent understandings of how to interpret balance sheets and what kind of balance sheet is preferable to another, right? You did that all on your own, not me. So, I mean, that is a real major, you may not think it as a real major learning objective, because once you apply that template to, and I'm going to introduce the balance sheet of Air Canada later on in this session, so that we can apply, you know, this understanding. This is a major hurdle crossed. But I'm going to complicate things a little bit now, right? So we rank them. C is better than A, and A is better than B. So I want to go through with A and B, whom I've called Adrian and Brenda. Those are the two balance sheets, right? And we definitely said, I'm leaving C out of the picture. We definitely said Adrian's balance sheet. If we had a choice, we prefer to be Adrian than to be Brenda. Everybody agrees on that. So I am going to complicate things a little bit. And again, ask Yatika, I want you to use the chat or just talk. It's kind of like the wild, wild west with me because I like these interactive sessions. Can you think of a circumstance in which you would prefer to be Brenda than Adrian? Or in other words, in what circumstances would Adrian's position be less healthy than Brenda's?
So Monica has posted in the chat, and Monica, you talk all the time, so feel free to come on camera.
Feel free to talk, Monica.
As well. Yes, but if the liabilities are investments. So in response, B would be better than A. If liabilities are investments, Carol has mentioned if you are a business owner, it might be better to be Brenda. And Amanda says Brenda has a mortgage and Adrian has credit card debt.
Who was that?
So Amanda notes that Brenda has a
Okay.
mortgage and Adrian has credit card debt.
So let me deal with the first one with the investments. Remember, we have to be very, very disciplined in terms of how we interpret these terms. An investment is an asset. Remember, an asset is something that you own that brings you some value, either through its use or through its long-term market value that you could sell it. Investments, therefore, don't belong on the liability side. They belong on the asset side. So perhaps one of the things I would like to do is, if you can, Tika, and if you wish, who's the person who said that? Because I probably want to get to the bottom of why they said it to clarify, because it might be something that's confusing everybody.
Okay, I don't know, Monica, if you want to say a bit more.
Is it Monica who said if liabilities are investments?
Yes, yes, and not to put you on the spot.
What you mean, Monica, because it's important to get this right. So, and you know, often you know, this is not singling you out, but you actually might be talking on behalf of a lot of people. So can you share what you mean by that?
Well, I just thought that liabilities were money that you owe to somebody. Like, for example, if you invest in something, but you take some form of debt or
Okay, so I want
mortgage.
you to pause right there. Right, because actually, why that is good that you said that is because you're talking about two different things. You're actually talking about two separate, and this is often a mistake people make. They combine two things. So when you say you invest and you take a mortgage, right? Those are the words you use. The invest is the asset. You buy a house, that's the asset. You take a mortgage, that's the liability. You see what I'm saying? Now, now the problem is it is one transaction, right? And so that you are merging two different financial concepts in your head, and it's really important to keep them separate. You see what I'm saying? So when you use the word you invest in a property, right? You're talking about, I have purchased an asset, property, bam, left-hand side, balance sheet.
Okay.
I have taken a mortgage to buy it, bam, right-hand side, liabilities. Go on.
What happens if, for example, you buy a really expensive designer bag that's for sure going to increase in value as time goes, but for now it costs more than the bag was actually worth, so there's more liabilities than assets, but you know it's going to grow over
again
time.
Stop. You can't say there are more liabilities, but when you say there are more liabilities than assets, what do you mean?
I mean, it costs more. Like, you know, you got a little bit ripped off when you bought it, but you know it's going to be worth more over time.
Right. So I want you to pause here because I don't want you to leave or anybody using the wrong terms. You're bringing up really great ideas, but still using the wrong terms to express them. So let me rephrase what you have said using the right terms, but what you have brought up is really an important point. So you buy a bag, a designer bag, you say. It costs you $1,000. Is that, maybe it should be more, right?
More like 50,000 perhaps. Okay. I don't know.
Oh God, who does that? Okay, Monica, go for it. So you buy this designer bag for $50,000, right? Actually, let's make it more, this work of art, right? That you think, okay, it's, you know, it's an upcoming artist, and I know in 10 years time, this person is going to be, you know, so well known and great, because that's what people do with stocks. That's like my cousin with the Shopify. You want to find that thing that you buy now, that even if it's overpriced now, which is the point you're making, Monica, in 10 years time or in X number of years time, its value goes up. So here's what you are saying. You purchase an asset now, it costs you $50,000. Its market value, its value may be less now, right? So you purchased it for $50,000.
Yep.
You say you got ripped off because you know if you have to sell it now, if you are forced to sell it now, you could probably only get $12,000. Right? That's the point you're making.
Yeah.
There are no liabilities in what you are talking about there.
Oh.
What you're talking about is buying an asset, as is the case with most people, like a car. That's the point I was making. Its value diminishes immediately as you use it, right? You buy a car for $70,000, and as you drive out of that dealership, if you had to sell that car the next day, you cannot sell it for $70,000. You can only sell it for 50, for example. So it's no difference. What you're talking about is a more extreme case, but there are no liabilities there in that conversation. Now, you may want to import liabilities into the conversation. And I think this is where you're coming from, that you may have purchased, let's go back to the bag, right? You may have borrowed money to purchase the bag, which is a separate issue. You still have a bag that you have in your assets thing, $50,000. You borrowed $50,000, so now you have a liability of $50,000. You with me there?
Mm-hmm.
If the bag's value is less than $50,000, your liabilities are more than your assets. And I think that's the point that you're trying to make. But don't ever use the word investments, right? Because one of the things is that, which makes accounting difficult, is that people use words that we use in our normal everyday language, which means something in our everyday language. They import them into accounting, and then things become confusing. So if you kind of remain disciplined, knowing that an investment is an asset, a liability has one single definition. It's something that you owe, and you can acquire an asset, which is one transaction, by borrowing, which is a second transaction, and it populates two different sides of the balance sheet. When you acquire the asset, it populates the left-hand side, right? And if you acquire it using borrowing, it populates the right-hand side. I want to pause here, there's learning here, Monica, and this is what I want to try to bring out to everybody else, that when you make a mistake, it really helps us all, and it gives me an opportunity to explain things, because there's another learning here. You can acquire assets by not borrowing. You can acquire assets from your cash. And all that happens here is, if you purchase land or that bag, let's say, for $50,000 using your own cash, what happens to your stock of assets?
It diminishes.
No.
Increases.
It doesn't. No.
Stays the same?
It stays the same, because you reduce your cash by $50,000, right? Let's think about it. Let's say this, for the time being, this was $100,000 cash in Adrian's balance sheet, right? So he has $100,000 cash. How has he, sorry, 1 million. He has $1 million cash in the bank. 500,000 he's borrowed from the bank. So he's borrowed 500,000 and put it in his own bank account. And he had his own 500,000. If he takes that $1 million cash and purchases a property, cash goes down by $1 million and property goes up by $1 million. So the stock of assets remains the same. So what you have helped us understand, Monica,
Wow.
is that,
No, I was just like, wow, I've helped everybody understand. Wow. It was all you, but I followed through.
Yeah, is that, and with that transaction there, net worth remains the same. We have transformed our assets, right? Right now, I just have a generic 1 million, but we can engage in a transaction, right? That says 1 million cash, that's my total assets. but I can convert that $1 million cash into another asset, property. Nothing else has changed. That balance sheet there remains exactly the same because I've just converted one asset into another. Now, by converting one asset into another, to Tika's point earlier, my prospects may be better, right? Because having $1 million cash, all I will have is $1 million cash next week, right? And at the end of the year, if I keep that $1 million cash under my mattress, at the end of the year, I have $1 million cash. But if I take that $1 million cash and invest it in property and sit and do nothing, at the end of the year, the value of that property would likely have increased. My total assets, therefore, would have increased by me doing nothing, right? Simply the passage of time. And if my total assets increase in value, so would my net worth. I don't owe the bank any more money because my property went up. I owe them the same, but my wealth has increased. You see the point I'm making there, Tika? Sorry,
Monica.
It's just that I have both of you in front of me, right?
No, and that's a great point. So Dora has a question, but I just want to say, Monica, correct me if I'm wrong. You are still in high school or just transitioning out of high school now?
Well, I've graduated this year. So
congratulations.
Thank you. So I'm going to Cégep because I'm in Quebec.
Okay. And
Yeah.
what are you doing? What are you doing?
Oh, well, I'm in Cégep. I'm going to be in this program called, in English, it would be Science, Letters, and Arts.
Okay.
Yeah, you get a little bit of everything. It's going to be hard, but I'm excited.
You do well. You do
well. And
I
mentioned, sorry, I mentioned that because as much as, you know, Monica, we put you on the spot a little bit, like I've been here for about 9 months and you have like consistently been such an excellent participant, always engaged in the program. And you're a young person learning and helping us to learn. So thank you.
Thank you so much, Monica. So I want to push it on, you know, I think it was Amanda who really hit the nail on the button, that in order to really make, you know, yes, if everything is the same in terms of the assets of Adrian are the same as the assets of Brenda, and the nature of the liabilities are the same, yes, we can say Adrian, I would prefer to be Adrian than to be Brenda. But Amanda made the point, well, if Adrian's liabilities, that's $500,000 is credit card debt, that is a really costly liability, right? And that kind of liability could actually eat away at Adrian's assets. Because to finance that debt, you gotta use your assets, you gotta use your cash. Whereas if on the other side, Brenda's $800,000 liabilities is cheaper debt, it may be more, but the amount that she is paying to finance that debt over the years will be so much lower than Adrian's. It will not be eating out her assets in the way it's eating out Adrian's assets. So let me just, you know, throw up an example of the circumstances in which it might be better in the long term to be Brenda than Adrian. Now that we've unpacked Adrian's assets and Brenda's assets and their liabilities, they both have a home that cost $600,000. So they both have that asset, $600,000. But Adrian used his $1 million. You know, he bought that, what was it again, Tika? The 2011 Porsche.
Yes.
A flashy sports car. Well, no, it wouldn't be the 2011 Porsche because, somebody thinks that's going to have, great value in time. So it's a flashy sports. It's not the 2000. He made a mistake. It was the 2008 Porsche, right? So he bought us a flashy sports car. His assets are financed by a line of credit, $400,000, and credit card debt of $100,000. So I'm veering to Amanda. This is more along the realm of Amanda saying, well, his liabilities, he may have liabilities that are high risky liabilities or costly liabilities. On the other hand, Brenda, instead of the sports car, invested the $400,000. And this is the way you could use the word invested, Monica. Invested the $400,000 cash by buying another property, which she is renting out. So they have the same value of assets, 1 million. It's just the portfolio or the composition of their assets is different. And right away, we may make assumptions that, well, you know what, maybe there is more potential on Brenda's side because this asset, this property, she's renting out at $1,500 a month. So this property, that $400,000 is bringing in $18,000 a year. 1,500 a month times 12. Whereas the sports car, all you have is a flashy sports car and you look good in it when you drive, but it's not bringing in, it's giving you a lot of internal happiness, but it's not bringing in Adrian any income. And then on the right-hand side, we see that Brenda has a mortgage. It may be 2.5%. And maybe that mortgage, and this is where financial strategy has come in, the mortgage was probably used to finance the rental property, right? So she is paying 2.5% interest, which is about, how much that works out? What will 2.5% of 4,000 be? 10,000? Pull out your calculators. I should know. So she's paying, let's say $10,000 on the borrowings, but she's getting in 18,000. And of course, she's borrowed from her parents who are soft-hearted. That probably is a risk-free, cost-free loan. So even though Brenda's net worth is much lower than Adrian's net worth, we might all prefer to be Brenda than Adrian because of the composition of the assets. The assets reveal that there is a far greater income earning potential. There's a far greater potential to increase wealth with the assets of Brenda's, and a less likelihood that the cost of the liabilities is not going to erode wealth. Everybody gets that? Now, I want to go back to the sports car because it was good that, somebody, and I didn't mention the name.
Fedor
mentioned the 2011 Porsche. Okay, now if this were a 2011 Porsche, which I am going to assume, is, something that has value, maybe it may not be as bleak as I am saying, and that this particular sports car was purchased by Adrian with the view that if I hold on to this 2011 Porsche for 5 years, do nothing with it, yes, it's not going to bring me in any money, I'm just going to keep it, and in 5 years' time, its value would be $1 million, then we have a different conversation going on. Then we might all want to jump back to Adrian, but then still be worried that in that 5 years, right, where no income is happening from the Porsche, credit card debt is going to increase. And therefore, it still places Adrian in a very high risk situation. So, you know, the point that I wanted to sort of bring out here in this exercise is really, we can't just look at the dollar values. How am I going for, I can't believe.
Yes.
Seriously, I'm sorry.
No, that's okay.
Yeah, we can't just look at the, when should I stop, Tika?
I'm going to say, you know, you have another 10 minutes.
Okay.
And we can include some questions in that as well.
Okay. We can't just look at the dollar value of the assets and the liabilities. We really, what really matters in terms of, you know, financial health and financial prospects is the nature of the assets and the nature of the liabilities. And one of the, you know, biggest rules of thumb with financial management is that if you have a long-term asset like property, you should finance it with long-term debt. You shouldn't finance property with short-term debt and high interest debt. Finance short-term assets with short-term liabilities and long-term assets with long-term liabilities. And why? Because long-term assets, and I'll go back to the sports car illustration, because long-term assets only give you value in the long term. So you want, when you have to pay back for them, the liability that is associated with them is in the long term. If you finance that sports car with credit card debt or short-term liability, and you expect that in 5 years that sports car is going to give you, you know, a great profit when you sell it, then you should not use a short-term liability. You should at least use a liability that is as long as the period of time that it takes for this asset to increase in value.
Yes, if I may, there's a question in the chat asking if you could please provide an example of long-term debt. So perhaps an example of short-term liability, long-term liability.
Okay, a short long-term debt, the classic one is a mortgage. It's long-term, 30 years, right? A short-term, really short-term liabilities are like lines of credit. You know, credit card debt is short-term. You know, people keep it on for long-term, but it's really short-term debt, right? Because the real, you know, so let's look at two sides of the equation. The credit card company does not want you to pay it off, because once you don't pay it off, they keep earning income. That's their interest in this. They want you to have that debt for as long as possible, okay? But really and truly, from your standpoint, from the standpoint of the borrower, that should be short-term debt. You should be paying off your credit card, the entire balance at the end of every month, because it's so costly. So short-term debt, credit card debt is short-term. And if you use it long-term, you pay a huge penalty for it. And that is sort of, for me, the classic. I only have a credit card for air miles and to develop a credit rating. And when I use my credit card, I immediately pay it off. I mean, it's like, pay for this with the credit card, go in my bank, online banking, and pay it off. I do not even want, and my son will tell you, there was a month that I had to pay $2.09 interest because I was away and I forgot, and I went nuts, right? Because the whole idea of paying credit card interest, for me, it's an anathema, because it's such, it's just high cost. It is the most cost, unless you go into a loan shark, and then you could probably lose your life. But that is the highest, the most expensive form of financing, because it should be short-term. And people don't use it as short-term. Does that answer the question, you think, Tika?
Yes.
I can't see everybody, I'm only seeing you.
No,
so.
no. Sorry, Carol, if you can let us know. So there were two questions beforehand, and maybe we can take them here. One was, first is Fedor, and then the second is Kofi. So Fedor, if you want to go ahead.
Yeah, can you hear me?
Yes.
Yes, hear me.
Fedor from Windsor, University of Windsor.
Yes, that's where I'm from. Yeah. Accounting and with a minor in political science. Yeah, no, I really enjoyed your last session. It's so amazing just having a teacher that's very engaged in the subject and it's not boring, and it's just phenomenal. I really appreciate that. Just good energy. So in regards to the classic car, I think of it as in, like, although you may think of it as a liability because you may not think you're getting much of it, but
stop. The car is not a liability, it's an asset.
It's an asset. That's what I'm saying. Yeah, that's what I'm saying. But some people think it's a liability. But
and what I want them to do is stop mixing up English, you know, how we use words in English with how we should use them in accounting. A car is an asset. Right?
If you're making money off of it,
I know what you mean when we say in English it's a liability, it's a handicap, right? It's not bringing any value. No. So the way to rephrase it, I'm sorry, because I need to be, you know, to be very pedantic here, so that we don't get English and accounting mixed up, right? It's a bad asset, but a bad asset is not a liability because you don't owe, right? It's an asset. So continue.
Yeah, because technically, I actually went to a dealership the other day, and I was kind of practicing what I learned in school about leasing a 2021 Corvette, and I was able to get this guy to sell me a Corvette, even though I didn't tell him like I had no money, I'm a student. It was just like, wow. So anyways, I want to say that because with such cars, like classic cars like this, if you lease them, then you register under your business as a leased vehicle, business expense, tax deductions, maintenance, tax write-offs, insurance, gas, kilometers. You can depreciate to be like to the equivalence of like a $30,000 car, right? So it's in terms of like opportunity cost, it's the taxes that you're saving. So it's phenomenal. But and I just want to just ask you a question. So a lot of people don't understand that. A lot of people don't think that they have assets in their home, but they do have assets in their home. But if they, let's say, start a corporation and they put their assets under their corporation to attract clients and stuff like that, that's also a tax write-off. So what I want to ask is that, let's say I have an art piece that I bought from the art gallery. Let's say it cost me $400, and I'm like, I don't want to put it in my house anymore. I want to put it in my office in the business that I own. So clients come in and say, wow, you have a great art piece, right? and it's making me sales and stuff. So in that case, I'm able to get a tax deduction because I can amortize that asset, right? And I can claim the depreciation on it and so forth. So in that case, that art that I purchased, right? Or even if you go back to Monica's example of the designer bag that she was talking about, she can, if she has it under business, she can still claim depreciation on the loss, on the value of the bag, although it may not be at market price. She can still claim it if it's under the business. So what I want to ask is, in terms of asset and liability, where would this fall into? Like what category? And especially when it comes to financial reporting or in the balance sheet, where does that fall into? Would this be a liability or an asset?
The art?
The art or the
It depends
bag?
on whom you're accounting for. If it is, you're saying the art is purchased by the business.
Yeah, that's right.
It can only be an asset.
Okay, cool.
Right? It'll be an asset for the business, right? You know, an asset is something that is, an asset could never be a liability. An asset could be financed by a liability, but that does not make it not an asset. What you've done is created an asset and created a liability at the same time. An asset that you purchase, like a car, you know, when people say that car is a liability, what they really mean is that car, having that car, the amount of money I have to pay to maintain this car, it's always breaking down. I've got to fix the engine. I've got to do this. That car is eroding my other assets, cash. So when we use the word liability in common English to say this is a liability or that is a liability, we are not using liability in the accounting term. We are saying that really this particular asset is causing us to diminish the value of another asset, which typically is cash, right? Kofi.
Thank you. Yes, I just wanted, let's talk a little bit about cash, and I want you to, because sometimes
I have a whole session on cash, actually.
Beat of cash, and I don't, and sometimes they say cash is king, cash is queen. But could you tell us? It's a two-part question. The first part is, could you tell us how important is cash flow? Because it's very important that you might have assets and go bankrupt, and you have billions of assets and you lack cash flow. So I need you to touch on that. And then the next part is about debt leverage, debt management, and the credit card nowadays. They have something called where they do a balance transfer. They will charge you 1% and you could take 10, 20, 30,000 and not pay any interest for 10 months. Could you talk about how those two things could be used and if it's wise?
Okay. First of all, cash flow, in my plan, it was week 1 and 2, wealth, week 3, income, week 4, cash flow. So if you kind of wait and then week 5, friends of Marcia, right? So we will get to cash flow because, and that is really important because, the 3 major financial statements are the balance sheet, the income statement, and the statement of cash flows. So again, remember, we are looking at this through company accounts, but I want to use that, the lens of understanding financial statements to our own personal lives. So if you could wait a little bit, Kofi, I'm going much slower than I planned, but look, I like this, you guys like this, and if I have to spill over, I will into more weeks, as long as Tika and everybody are happy, because I think it's important to get certain things right. But I definitely will get to cash flow statement. In terms of the credit card and the balance transfers, it makes sense to do a calculation. If you have credit card debt and you're paying 19% on it or 20% on it, and another company says transfer your credit card debt to us and you will pay 0% for 12 months. The important thing is that transfer also comes with a transfer fee, right? So if the transfer fee is $50 and the interest that you are paying, let's say you have $20,000 worth of credit card debt, and you are paying interest of, you know, of more than, you know, $4 a month, it makes sense to transfer it, because the cost of the transfer fee, which is the $50, is going to be less than the interest that that you would have paid. So I would say do it, but have a plan, because you don't want the 12 months to pass and you have not paid down that credit card. You know, I implore everybody to not use credit card debt, because for me, I'll tell you what credit card debt means to me. That you're living, I see it as indication of living beyond your means, right? You don't use credit card debt to buy a house. You don't use credit card, or you shouldn't, right? And if that is the case, then don't do it. You shouldn't use credit card debt to buy a car. What do people use credit card debt for? You know, to buy disposable things, you know. Let me buy a pair of shoes, let me buy an outfit, I like this, I like that. It means you're living beyond your means. You're living beyond your income. And because it's so costly and pernicious, and I will tell you a personal story. I have a relative who lost their house because of credit card debt. So, you know, it is something that the only agents that benefit out of credit card debt are the credit card companies. And it was something that was devised really to create a consumer culture in us, to create a culture in us that says, well, you know, you don't have the income to get this, but you know what? You can get it. Instead of saving, right? And what saving is a kind of discipline, is a kind of deferred gratification. Said, you know what? I really want that. Let me save to get it. What credit cards do is break that discipline in us, right? That says, you know what? I want it. I can get it now. I don't have the money. Let me flick out my credit card. And you end up, you know, paying 19%, and every month that you don't pay, you end up with the debt, the interest, the accumulated interest eventually becomes larger than the initial amount that you borrowed in the first place. So, you know, I feel, you know, I cannot underscore enough the point of how dangerous credit card debt is. Kofi, does that help?
Yes, definitely, definitely. Compound interest is dangerous.
It is, and then when it's high. I just, sorry.
So I just want to do a time check that we have about 5 minutes left. There is one other question. What about having a credit card for business? I don't know if you want to address that now or at a later point, but.
Yeah, I mean, if you know, if the credit card is used for business, it's the same thing. You know, what obtains for a business and for an individual, to me, are the same, right? If the you know, the difference is, and you know, Tadu brought up a lot of, you know, a lot of things in what he spoke that I didn't want to get into. The difference is, as an individual, that interest that you pay to the credit card company or to anybody, that's just on you. If interest is now considered a business expense, right? And, you know, in the next session, we'll talk about expenses and so on. If interest, that credit card interest, let's say, is 19%, and let's say over the year you paid, let's say $3,000 as an individual, that's on you. If that is a company's credit card, and that is an expense, they get a tax, they get tax savings on that, right? So that even though they pay interest, right, because it's an expense, it reduces their tax payments. But, you know, I just again want to make the point, you know, when people say, oh, I'm doing this as a tax savings, well, it's not really a tax savings. You know, you have to pay the money to get a tax savings, and you will never get back in terms of tax savings more than you pay. It just reduces, you know, the net cost, so that, you know, it really is also not sensible to say, I'm gonna spend this because I could write it off for tax, right? Because you spend 3,000 and you could probably only write off 1,000. It means in the net, you're still spending 2,000. I am probably going to end here and just take questions. And then next week, we will talk about the, you know, I just want to complete here and do the balance sheet next week, take this to the balance sheet, and then do the income statement. And then the final week, we'll do cash.
Okay.
Questions?
Yes, thank you. So we have 3 minutes left. Are there any questions? There is one in the chat. Is it okay to pay down and closed credit cards? I don't know if you.
Yes.
Comment?
It's, well, you know, the answer to that question is a resounding yes. It makes sense to, you know, you don't need a lot of credit cards. Pay them off as quickly as possible. You know, and the other thing about credit cards is you could have a zero balance on a credit card. When your credit score is being calculated, what is considered in determining your credit score is not your zero balance, is the credit limits. So you may have a credit card, you may have 3 credit cards, one with a credit limit of 10,000, one with a credit limit of 20,000, one with a credit limit of 30,000, and you may have a zero balance in all of them. As far as a lender is concerned, your indebtedness is the sum of those 3 credit limits. So why have a credit card with zero balances? One, get rid of it. If you're not using it, cheer it up, call the company, tell them, take back your credit card. That's one. 2, if you have debt and credit card debt is part of your debt, your single focus would be to be saving money to pay down that credit card debt, because credit card debt does not go away if there is not an active plan to pay it down, right? Credit card debt, to me, is one of the signal most pernicious inventions of capitalism. It has created, and capitalism, I mean, I don't want to go off, but I will. Because I'll tell you something. I remember growing up, I grew up in Trinidad. And I remember growing up, and the fridge that we had, okay, and stove that my mother had from when I was a child. I think we changed it when I was a teenager, like about 15 years. And from that every 3 years or every 5 years, we had to buy a new fridge. Is it technology have we regressed, right? You don't think that they can make fridges and stoves that last 15, 20 years? No, they can. But they've decided, let's make these things that last only 3 or 4 years because it benefits the business to have you coming back. What business does not want repeat customers? So these things now are designed to last a short life so that you can come back. And therefore, what facilitates that coming back is credit card debt, right? So that you're no longer encouraged to save, to buy the fridge or stove that is going to last you 15 years, right? You create fridges and stoves that last only 2 years, 3 years, 4 years. Give the consumer a credit card so that even though they don't have the money to buy it, they can use the credit card to buy it. I've gone off, I'm sorry. But it's kind of one of those inventions that really create the consumer culture, create a culture in us that we keep buying and buying things that we do not need with money that we do not have. And we end up being indebted for life.
Yes, we end up with more liabilities than assets.
Absolutely.
to bring it back. Thank you very much for this. Thank you, Professor Annisette, and to everyone for, I think, another very engaging and insightful week of discussions. I hope to see you all next week, Saturday at 10 a.m. sharp for the third week with Professor Annisette, and she's with us for 5 weeks. So we have 3 weeks, 3 weeks left. So looking forward to seeing you. I just want to highlight very quickly some initiatives that are coming up for the BBPA next week. And Victoria's gonna, thank you. So on Tuesday, please join the BBPA's Boss Women Entrepreneurship Training Program, where they'll be talking to Michael Adit about growing your business and growing your sales. On Wednesday, they have Professor Daylon Taylor at their Ask a Professional talking about some of the issues and systemic issues, rather, that racialized communities, particularly the Black community, is facing in COVID times and post-COVID times. And then, of course, the Braids program, which is free of cost to businesses, that's looking at how you can make your brand pop, focusing on your website and social media. So please visit the BBPA's website. Of course, go to our YouTube page to look at past recorded sessions of this cohort and our financial literacy program prior to. And we are looking forward to seeing you again on Saturday, 10 a.m. sharp. And tell a friend to tell a friend so we can have more folks out. Thank you so much. Have a wonderful weekend.
Goodbye, everyone.